Hey, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, May 3rd, 2023, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead trader Viper XL 007. And we have a fun episode today, well, sort of fun, to cover some stuff, and that is stocks really do go to zero. You know, people always say, well, they can go to zero, but when's that ever going to happen? So we are going to break down a couple of topics here. We're going to first discuss how much is a quarter worth. And this is about the Fed today raising interest rates another 0.25% again. And some strikingly odd and haunting similarities to the 2008 financial crisis are really kind of starting to take shape out there. And I kind of want to call out some of this stuff because it is really interesting how similar yet different those things are. I believe it was Mark Twain that said, "History never repeats itself, but it often rhymes." And lastly, we are going to touch on the topic stocks can go to zero, a failed bank, and how does that feel? It was just last episode where Viper and I were pretty much advising against trading on FRC. And yep, the inevitable happened and they have gone bye-bye. And Viper and I are now proud owners, well, likely proud owners of a defunct bank. But before we hop to those topics, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, several other Blockhead traders. In fact, you can probably even participate in some friendly banter about the current banking crisis because actually there's quite a few traders in there that like to follow the financial sector and trade in it. Lastly, you can go to thetagame.com/sprocket888 where I post each and every one of my trades, the good, the bad, and the ugly. And don't forget to pick this up wherever you get your podcast so you can listen to an audio-only version wherever you're going. Is a little more convenient than staring at a screen and our talking heads. So, Viper, let's hop to the first topic about how much is a quarter worth. And I kind of framed it that way because today Jerome Powell came out and, as expected, raised interest rates another 0.25%. And I framed that question of how much is a quarter worth because there's a lot of debate going on out there in the financial world, in the markets and things like that, that, hey, inflation is on its way down. There's no need to keep turning the crank. Things are heading in the right direction. Turning this crank creates more problems for us. So the longer that you kind of keep the heat rising, the more systemic or long-term consequences you might have. The flip side of that is, well, if we don't squash this thing like a bug, we can get into a really more difficult situation of like a stagflation where, you know, inflation is on a runaway train and you can't kill it because you can't raise the rates to knock it down because the economy is in such an area, and you can't cut rates because if you cut rates, you drive inflation higher, and then you get into a position where you can't deal with it. And so those are kind of the two sides here. And I say, you know, how much is it worth? Because the Fed did indicate that they're going to back off, let things play out, see how things look. They certainly didn't really use any language about any rate cuts coming anytime soon. But there was a lot of references to kind of this is the end of the hiking cycle. And so the question will always be out there, you know, was this last quarter worth it? Yes or no? And time we'll have to wait and see what time says on how things turn out. And even then, no one will really know what would have played out differently had something else happened. So I think it's one of those questions that never really gets answered. So the other point that I kind of want to bring up, and this is not really going to meant to be a deep dive into some of this here, but that is the hauntingly similar events between the 2008 financial crisis and the current crisis of confidence or solvency in some of these regional banks. And, one of the things that I want to call out as an interesting similarity is in March of 2008. It was March 14th, March 17th, something around there. Bear Stearns was a financial institution, a very large financial institution, and they ran into some serious liquidity and solvency issues. And as a part of that, they went in on a fire sale essentially, and they basically said, "Oh my gosh, we're in big trouble. If we go down, we are such this pivotal anchor in the financial world, and it will just rattle confidence in the whole industry." And keep in mind, what led up to that point was really this rate cut to just historically low interest rates. And these banks were hunting for yield. They're hunting for returns. And so the only way to get returns was to kind of send money out on different loans and things like that. Well, they couldn't charge a lot for the loans because the interest rates from the federal government were so low. And a lot of people that needed the loans had already gotten them. And so they didn't really have a huge market share left out there to go sell loans to. And so they started going deeper and deeper down the credit rating of consumers. And that's where this whole subprime crisis came from, is the banks basically pared back a lot of their criteria so that they could lend out money to these subprime borrowers so that they could pull in some money from the interest rates of them. And so they just went to scale on that. And one of the problems was the money that they were taking in from the interest wasn't really padding their pocketbooks enough for the default risk of those creditors, of those clients that they were bringing in that had a higher risk of defaulting. So as soon as the economy would start to crack, these less than optimal borrowers would start defaulting. But the banks wouldn't have collected enough interest rates to kind of cover those losses, and they started taking big hits to their balance sheets in their books. And that's really kind of where this avalanche or this snowball started to roll down the hill. And Bear Stearns was one of the first victims of this snowball as it was gaining steam. And the industry said, "Oh my gosh, we got to stem this off now before this thing turns into an avalanche and just crushes us all." And so JP Morgan, which is a big money center bank, largest bank, I don't know if they were the largest at the time. They are pretty much the largest bank now, came in and said, "Oh, don't worry, we can take care of this. We'll take all your assets. We'll backstop everything. We'll get this all under control. Everything will be hunky-dory. Everybody will be calm. The peace will come back to the market, and we'll all be fine." And so they came in at a fire sale. I mean, Bear Stearns was trading at like $172 a share the week before all of this unfolded. And JP Morgan acquired all of their assets and everything for, I think it was initially $2 a share. It might have later gone up to maybe $9 or $10 a share. But anyway, it was a fire sale, just massive discount. That was March. Then throughout the next spring and then through the summer, cracks began to get bigger and bigger in the lending industry. There was IndyMac, Freddie Mac, Fannie Mae, all of these kind of firms that were packaging up these mortgage securities started just really cracking and falling apart. Then in September, that's when the avalanche really broke loose. Lehman Brothers came down. The federal government basically said, "Yeah, we're not backstopping this" initially, and just the massive credit collapse that was what the 2008 financial crisis began to unfold. And go back, read your history books, but all kinds of things changed. All kinds of bailout money was put in. All kinds of TARP funds were put together to try to just save everybody in this liquidity and all the depositors and all that stuff. That was all in 2008. Fast forward to 2023, what just happened on March 10th and March 13th and 14th, around there, and then most recently here in last Friday, April 28th, we had a solvency issue in Signature Bank, Silicon Valley Bank, First Republic Bank. And what basically happened is these banks became insolvent. They couldn't have enough funds to cover depositor withdrawals. The FDIC came in, they seized some of it, they started pawning it off. The most recent one, which we'll talk about in a little bit, First Republic Bank, FDIC came in, and who was the white knight that arrived to save them over the weekend? None other than Jamie Dimon and JP Morgan. Similar to the Bear Stearns situation. They acquired all of the assets. They got a little bit of backstop in there. And if you read the news articles, they're doing this to put this to bed, stem the crisis of confidence, prevent this thing from avalanching forward. So is this the beginning? I don't know. Just this evening before Viper and I started recording, PacWest, which is another one of these troubled banks that has kind of been on the radar, rumors started flying around that they're seeking sale. And after hours, their stock fell another 60%. They've already been beaten down somewhere on the order of 95%. And there's a whole list of regional banks that are kind of in this similar boat out there. And is this history kind of repeating after, 15, 17 years or what? I don't know.
A little bit of a tangent, so I'm not going to spend a ton of time on it. But all I can think about looking at this is generalizing it. And we're all familiar with almost just about a year ago when the crypto world started to fall apart and the market collapsed there. And it just, it's this like that we talk about all the time about how crypto follows the lessons of fiat economies just at a rapid speed. But this one, it was reversed. I mean, well, I don't know. I mean, it maybe not reversed if you're looking at 2008 to now or whatever, but man, if you generalize some of these things, like it's the same exact thing. I mean, you had a protocol. So yeah, let's just say a thing. You had a thing fail because it got knocked off kilter and liquidation started cascading and insolvency issues came up. Then you had another thing that came in and said, we're gonna buy this, and everybody that was a victim of that collapse, I'll start using names. So BlockFi starts to fall, and these things, which would be like your regional banks, start going down, and then you had this big money bags player in FTX and SBF come in and say, we're gonna bail out BlockFi, we're gonna buy these things because we don't want to let this watershed moment rip through our industry. Obviously, you probably recognize those names, SBF and FTX. And then it turned out they were buying that on over-leveraged money. So it just, oh, geez, ow. Just stop there so we can move on. But it's, I don't know the word, ironic, I guess, that, it's a law. We'll call it a law of economy. You get into these over-leveraged investments, whether they're required or not, whether we accept them or not, as far as banks and how they need to earn interest to pay, yada, yada. Law of economies, I guess. Come in and do what they do.
Yeah. Let's actually take a look a little bit about the mechanics here, to kind of show how some of the stuff unfolded here. So in simple terms, I tried to kind of put this in as simple a graphic as I could. This is kind of what's going on with these regional banks. They got a pile of cash. Sitting there. This pile of cash came from their depositors. First Republic Bank, which we're going to talk about. They catered to a lot of wealthy clients. They, good customer service, personalized deals and things like that about, oh, we'll get you tickets to this show, or, oh, you want this, almost like concierge type service. And they're like, well, hey, you know what? I'll get all this stuff, and, oh, you got a decent interest rate, whatever, I'll give you this. And, oh, I want to buy this huge multi-million-dollar property. Oh, you'll give me a interest rate on my mortgage at only 2%. Oh, that's so nice of you. Because these people are very wealthy, they're very likely to pay them back. So the bank was just kind of loaning this out. And what's happening here is they've got to do something with all this cash that they have, because they're a bank, they have shareholders, they need to return value to the shareholders. And so what these banks were doing is they would kind of divide up their pile of cash. And I kind of put a big block in red. This is part of their capital that gets tied up in products, their loans that they put out there. It is saying, oh, hey, we can't find enough loans. We don't want to take on all that risk. So let's take on some lower debt, not debt, but lower interest rates by buying treasuries. They're guaranteed to pay us out, the 0.5% of the treasury, the 1% of the treasury. So it's, it's not the best, but I can't find enough customers to put my loans out to. So I'm going to buy all these treasuries. And these are like 10-year treasuries, long dated notes. And then, they keep this sliver of green cash, and that's the cash that's available in case somebody says, you know what, I want to take out $20,000 because I'm going on a trip, and, these are wealthy clients, whatever. And it's to cover, withdrawals, expenses, things like that. And as long as they can kind of cover those, it's no big deal. And this is how every bank operates. Nothing abnormal here. And where they started to get into trouble, and I'll kind of go to the next slide and then back to this to talk a little bit more about it, is these treasuries. So they were buying all these long-dated treasuries back here at these kind of elevated price rates. So yield, interest rates, and prices of bonds are inverse. So if interest rates go up, the bond prices go down. And so you can see from about September of 2020, when we starting to look to raise interest rates, the bond prices, and these are the 10-year treasury bonds, start falling. They fell 30% over this year of interest rate hiking. And this is the hike that we've been through, this rapid hiking. So okay, the banks are like, yeah, whatever. I'm going to get all of my money back plus my interest, in 10 years when everything is all fine, right? Well, let's go back to that pile of cash. That's all well and good, except what's happening is the feds are raising interest rates. So that means borrowing new money or investing new money, you can offer new products. So banks are starting to come out with 4% money markets, 4.5% money markets, saying, hey, if you come bring your deposits over here, we'll give you 3.5%, 4%, something like that, because rates have gone up. So they can get money from the treasury at a lower rate, pay more to you, or pay more, borrow money, get a bigger return around, say 5%, pay you 4%, they make 1%. You're happy because you get 4%. They're happy because they get a net interest margin of 1%. So what happens? All these wealthy people at First Republic say, wow, okay, it's nice that you have all this service, but I got $1 million with you. I would rather get 4% on my $1 million than 0.5% that you're offering me. So thanks, bye-bye, I'm pulling my money out. And when enough people start pulling their money out, this green box, it's all gone. What do they have left? They only have the money that's locked up in this long-dated treasuries. So the only option they have to do to get the money free, to free the liquidity, is to sell these treasuries so they can get the cash for what's left on them. But they have to sell them at a loss because they bought these things 30% ago. So they have fallen 30% in value. So now these banks are basically booking the loss because they don't have the liquidity or the solvency to hold them to maturity. So, but they've got to cover their depositor withdrawals. And that's where all these banks are getting into trouble. The people are fleeing these regional banks to go to these higher return interest products because it just makes financial sense for those individuals. But the smaller banks didn't plan for this amount of withdrawals, and they get caught in this bind of a situation.
And I would add, compounding the issue is, in addition to everything you just said, picture that you have $1 million and it's sitting in one institution. And as far as I know, I could be wrong because learning in real time and all that. Every bank, whether you have $1 million, $10 or $50 million, you have an FDIC insurance. Where if your bank is FDIC insured, the FDIC insures up to X amount, which is $250,000. And where I'm not entirely sure is whether that can increase or decrease, whether a bank can have any additional insurance or whatnot. But for sake of argument, we'll say $250,000 across the board. You have $1 million in there, and we're in this environment. We're in the environment where banks are failing. SVB, which had high-ranking customers as well, goes down. People are losing money that had more than $250,000 in the bank because they were insured up to $250,000. So in tandem to, I could go get more interest rate over here, there's also this mentality of I have $750,000 that's unprotected. So now it's a double whammy of, no, let me take that money and go put that in the higher interest, draw down to my limit of 250. So that way, if First Republic doesn't make it, I'm covered. And then I've also made my capital move to a more efficient place and now increased my insurance coverage by going to a completely different FDIC insured institution.
Yep. 100%. That is another factor that's basically coming into this and kind of putting that pressure on these regional banks. And that's what you're really seeing playing out right now in the market when you hear about the regional bank this and solvency issues and things of those natures, which is something that we mentioned a few times here, First Republic Bank. And First Republic Bank was a big cornerstone in our previous episode. The volatility was super high, and it got to a point where, man, that premium was just so tasty. Had to take a bite. Viper also took a bite. So, Viper, what's happening with our First Republic? That's not going well for us.
Yeah, I'm reminded now of the movie Cars. I believe it's Cars 2. Could be wrong, though. Where they're at the fancy dinner, and Mater finds his way to the buffet bar, and he sees this green ice cream and takes a bite, and it's wasabi. And he starts freaking out, and he says, "Don't eat the ice cream. It has turned." That's what this feels like. Yeah, I thought this was going to be a tasty bite. Instead, it turns out it was a wasabi. We thought we were getting ice cream. So, yeah, if we take a look, I guess we'll jump into the chart here because this is entertaining at best. History of the chart, you see, okay, there's a big cliff there, but this is like one of those how big you are in relativity to the universe. One of those videos where you got to like keep zooming in because there's this big cliff here, but where are we today? Well, we got to start our zoom in journey here, and we just got to keep zooming in here, and there's another big cliff now, and then keep zooming in, and we're like, oh man, what in the world? But like, we got to keep going, and there's another cliff, and now here we are, fast forward, sitting at 33 cents on the dollar. So, what happened is, we're still unpacking this in real time. This was also before like we sound too doom and gloomy or wasteful or whatever you want to like. We said it last episode. Like, if this goes to zero, this will sting, but this isn't like, the account will keep churning, because position sizing. So at this point, it's a ride to see what the heck happens when you're caught up in this, because we're basically at zero. My $10 put options contract that I sold is now worth I don't even know. I didn't look. But it's down 99%. So it's basically expired. Well, it's basically worthless. But what happened here was very interesting in the sense that like the sequence of events. So we obviously talked about it last episode of the bank could go into receivership, wondering what does that look like for us if that happens, if the FDIC, so receivership is obviously when the FDIC steps in and says, hold up, we're securing this thing. Exactly what happened in SVB. So Sprocket and I went back and forth on theories of receivership of like, okay, are we actually in good shape if they go into receivership? Because they go into receivership, everything's frozen, and it's just there's nobody can call back this options contract from us. And then channeling my inner 7th grade attitude of studying for a test or doing homework by just ignoring it exists. Maybe we could get into that situation where just everybody's like, oh well, like just walk away, and we end up coming out scot-free with 100% profit. But a couple things were a little different in this case versus SVB. So, which actually I shouldn't say that because it does sound like there was settlement of the situation in SVB. We just, had to really dig for it. So what's happened so far is, and then this is where I'll say how I viewed the events, and then Sprocket can clean up anything I missed or misstated. But the FDIC did sweep in. We got news of that Friday after the bell, but before options chains locked down. So it was like 4:30, I think, that rumors really started swinging up of like the FDIC is coming in, FRC is going to shut down. And then the news hit around 5:10, and I believe options are traded till 5:30. So Friday I got a little excited. I was like, receivership, it's happening. We're clean. And then Sprocket was like, well, no, not yet. Somebody could have called that away on the news. We'll know by 2:30 in the morning. And so Saturday morning I wake up, I check my account. I still got the contract. I must be good. But also the FDIC had not made any moves to do anything. We go through the weekend. Auction process starts, and they set a deadline for noon Sunday, very similar to what they did with SVB. It was a Saturday or Sunday auction for SVB as well. But then things got weird because, well, at least weird to me. I don't know. Maybe if you're watching this and you've been in this industry a while, not weird. But the auction process happened. JP Morgan, classic white knight in shining armor, while also possibly a 3 headless horseman based on 2008, steps in, wins the auction or whatever. And then as far as I understand it, JP Morgan comes in and just scoops out all the junk inside of the bank, and puts it in their pocket and says, it's okay, we got this, we'll cover it. And in that scooping out, they're scooping out these treasury bonds and whatnot, which they'll just hang on, and then they'll let them ride out to full maturity, and then they'll get their profit on it and do whatever. Meanwhile, the shares, like as far as we know, there's very little, if anything, backing the shares now. So, as far as we understand it, that's where we're at. And we thought, well, maybe the shares are done, maybe everything's still done, but then we find out that the ticker just changed, and because as you may notice here on the screen, it's not FRC, it's FRCB, which is the inherited new ticker that represents basically nothing. I think it represents 0. So we still haven't got a sign, but by the time you watch this, assume we're doing really good on predicting the future these last couple episodes. So sure enough, next episode, we'll flex our portfolios and be like, I got 100 shares of this stupid, worthless shell.
Yeah, definitely. It's it's kind of comical. I would actually, I'll make a plug here for our whole education. Know what you're doing. Know what happens. What are the mechanics? 100% Viper and I did not know the mechanics on what actually happens if this thing goes into receivership. We were doing some studying over the weekend, kind of cramming after we already took the exam. So, you learn something and it doesn't do you any good. Now, to be fair, we did know going into this that we didn't know. And the whole trade was based on the premise that we're going to zero. We're okay with that. If we were not okay with that, we would have bailed out, taken a loss earlier. So part of this was, hey, let's go learn this. Let's see what happens. There's nothing more impactful in your brain than living a lesson. So I'm here to live the lesson, and the position sizing is so important, so important. I'll put a link up above to our position sizing episode because it's really how you survive. In my particular case, I was worse off than Viper because I sold 16 Delta puts, which effectively is $16 a share, which means 100 shares is $1,600 loss. To put that into context, my other position that I happened to be playing at the same time as FRC was in the Russell 2000, and I closed that for a profit of 1541. Yin and yang. Yes, it sucks because I didn't get to book that whole profit, but look, my clock is going to keep ticking. So I want to put a plug in there for understand what happens. And so, yeah, we started reading up on it, figuring out actually SVB, it didn't really disappear. SVB got reclassified under a new ticker. The reason it got a new ticker is because they're kicked off the exchanges, the New York Stock Exchange, the NASDAQ, whatever it's on that it was trading, it's booted off of that. But the company still exists. The company still has shares. They must be traded somewhere, and they go into what's called an OTC market or over-the-counter market. And then when they're listed in the over-the-counter market, they need a new symbol to be triggered and to be traded on there. And so that's where FRC got FRCB. SVB is there. I can't remember the ticker. You can look it up. And all of the stuff basically just kind of flips over to there. There's some interesting things because in the OTC, they don't really allow opening of option positions on FRC. So if you went in there and tried to buy options or sell options now, you're not allowed to do any opening positions. You can only go in there and close positions. So what Viper explained is exactly what happened. JP Morgan came in. I think of it kind of like carving pumpkins at Halloween time. They came in and they scooped all the goo out that you might make pumpkin pie with, or maybe you like toasted pumpkin seeds, and all that kind of comes out the inside and the guts, and then you just got this shell of a pumpkin which quickly rots, and then you got to put in your compost or pitch it pretty quick. And that's effectively what I think has happened here is all of the loans, the values, everything went into JP Morgan. In fact, they got a sweetheart of a deal because the FDIC says, oh, yeah, you're going to have some bad loans in there, but don't worry, we're going to help shoulder the cost of that. So even JP Morgan doesn't have to shoulder the whole cost of the stuff that they scooped up. They get the interest rates from the loans. They get the payout from the long-term treasuries. They have the capital to keep floating everything. So that's what's going on there.
Yeah. And I would call out 2 points just so that way, because it is important to continually reinforce the point of, we're still in this, but we're not in it because YOLO. There were two very clear moments that are important if you were hanging around in our Discord, as this unfolded. One, there was a third party in the Discord that was wrapped up in this and even went, super bullish and had sold a whole bunch more puts when we were up there around $9, $10, $11 or something. And there was a point in the Discord on Friday where he actually bailed out because, too much and too much risk and just didn't want to mess around with it. And I very much considered, bailing out at that point in time as well. So there was that moment, and then there was another moment where when we crashed down to $6, there was some discussion in the Discord of that was a heavy volatile crash to $6, and man, did that not pistachio ice cream that was really wasabi look really good at the $2 puts. I looked at the chain, and the $2 puts were selling for, I think it was somewhere around $2, $2.50 premium. And I was tempted to pick some up, have another scoop. But we did discuss in the Discord, and I mentioned in the Discord, I said, you know what, it looks great, but I'm at my limit. This is all that I had to put towards this play. So it is what it is. We're not going to keep doubling down on this dish. So at least, bright spot of at least sticking to those core fundamental rules. I'm glad I did that. And even if it went the other way, and I wouldn't regret, because this is the equal alternative possibility, and you need to protect against that downside. So the last thing I want to add, as far as like we talked about what we understood going into this and accepting the risk and things like that, the final piece that made this the smoothest process possible, A++ would recommend, would not recommend, is what I learned in SVB, watching that all play out, because we did watch that fairly closely, is I had the full expectation that no matter what happened here, if you're a shareholder or you're tied up in shares on the market, quite frankly, my dear, no one gives a damn. And so I very much had that expectation in my mind of like zero entitlement of like, how could they do that? Like I have a lot of questions on some of the mechanics we're watching unfold. Seems weird, but I at least understood the roles everybody played in this process of, no, the FDIC's here because there's a whole bunch of people who didn't willingly walk into the fire, who just put their money in what was supposed to be a trusted institution. Those are the people that have full priority. Anybody playing around here, never expect to be protected or thought of as priority, because this is what it is as far as speculation and playing these games with these stocks. So just wanted to call that out as far as an expectation I had going into this, which I think did help the mindset of what was potentially going to unfold and now is currently unfolding.
Yeah. And I kind of echo that a little bit, with similar expectations, not specifically from SVB or anything, but just, hey, the expectation is this thing could someday be 100% worthless and nobody owes you anything. Nobody's out to get you specifically. And when it comes to claims on debt and equity and things like that, shareholders are always the last in line. The people that are ahead of the line in there are the bond holders that hold the bonds, and the people ahead of them are the direct asset kind of holders, or the depositors in this case. And there's a whole like priority ranking with that. And the schmucks that just kind of come in as just casual traders trying to squeeze a dime or two out of this, or run a crazy YouTube channel or things like that. Yeah, nobody gives a crap about those people, and those people, nobody owes them anything. So there's absolutely no sad feelings about any loss of entitlement here.
Yes.
It's just education. So that brings us to the end of this week's episode. The Fed going on another quarter-point hike. Did they turn the dial to 11? I don't know. Maybe it was just right. Maybe the porridge is too cold. Maybe the porridge is too hot. Who knows? Time will tell on how that shakes out. I encourage you to maybe take a look back in the history books on that financial crisis in 2008, because there are a lot of eerie similarities there. Just as the way some of these things are unfolded, the premise as to why they have to be done. We must stem the avalanche, stop the flow, stop the bleeding. We know how that worked in 2008. Boy, I sure as heck hope that things are different now, because I don't really feel like doing that again. That wasn't a beautiful and fun time. But hey, Viper and I were on the front lines of learning what some of the stuff that happens behind the scenes go. What happens when you sell a put on something and it literally goes to zero and gets halted and removed off the exchange, and what kind of boat are you in there? Probably one that's running out of water, and so I think we're just going to be just stuck on the rocks there pretty soon, and we'll keep you posted on how that kind of pans out. Meanwhile, there's quite a bit of stuff circling out there with more banks that are bubbling up looking for possible sales. The FDIC is now potentially looking into a couple other banks to see, is this the end? Is there more to come? Who knows? All that we know for sure is with uncertainty comes volatility, and with volatility comes premium. And yes, I sold some premium and it didn't work out, but that is absolutely not going to shy me away from my strategy of premium selling. I'll be on the hunt for more. So you do what type of trading you like to do and go out there and hunt for your trades. As a lot of opportunities, I am sure, will be out there in the market. So good luck out there. And remember, think outside the block.